Alright, hey, how's everyone doing today? Today's lesson is going to be a brief lesson over risk management. My name is Chris. If you guys have any questions at the end of this lesson, feel free to comment in the comment section below, as well as swing by retailalgotrader.com, where you could shoot me an email if you prefer to do it that way. Brief disclaimer, information contained in this session is of shared opinion and experience and should not be considered as financial advice of any kind. I am not a licensed CPA, CFA, or CFP. This session is operating under the full Retail Algo Trader terms of service, which can be viewed at the following link. So, a brief overview. What is risk management? Defining your personal risk based off of what you're willing to lose, factors of risk management, as well as at the end we'll go over the 10-10-10 rule, which is a good starting point really for any new trader looking to develop good risk management habits, and for any seasoned trader, whether you have a way that you use risk management already defined, maybe this 10-10-10 rule can help you out as well. So what is risk management? It is defined as the forecasting and evaluation of financial risk together with the identification of procedures to avoid or minimize their impact. Risk management is essential but often overlooked prerequisite to successful active trading. After all, a trader who has generated substantial profits, over his or her trading years or even the past few weeks, months, whatever it may be, you can lose all of it or a huge portion of it if you're not using proper risk management. Risk management allows a trader to plan out the positive and negative impacts a trade can have on the overall portfolio before the trade even happens. So this allows you to plan your trades and avoid losing too much on any single trade. This will ensure you do not blow up your account based off of a few bad trades. If you do end up blowing up your account following good risk management, it's likely not due to your risk management, but more so due to your strategy, just being a poo-poo strategy, one that is not good, giving you, delayed entry signals, bad entry signals, whatever it may be. Good risk management will keep your losses low, but if your strategy sucks and you're losing on every single trade, eventually you're going to run out of money. All right, so defining your personal risk. Everyone has a limit to how much they're willing to lose per trade. That's what you need to figure out for yourself. So say you're starting with, $10,000. How much per trade are you willing to lose? 50, 100, 500. For this example, let's say you're starting with 100. So we'll say we'll decide to lose $100. That's the max we're going to lose. We're not going to decide to lose $100, but that's the max we're willing to lose. So for each trade you make, you're willing to lose 100. Now we take that $100 and we use that to define our position size. In order to define our position size, you need to define your stop loss percentage. So to do that, when a trade goes against you, you will acquire an unrealized percent loss. But how much of that loss is a good amount of loss to accept? All right, so you need to leave the position room to breathe, room to move. If you're getting in at say, $50 is your entry price, you need to give it room to fluctuate to like $50.20 and maybe down to $40.90, and it's going to do its little waves before it gets to where you want it to get. So you need to give it room to breathe. If you're keeping your stop loss right at 1%, you're likely going to get stopped out very quick. You want to widen that a little bit to give yourself room. So let's say we go with 5% for this example. You're willing to take a 5% loss per trade. You're willing to lose $100 per trade. With a $100 loss being 5% of the position, that equates to a $2,000 position size or 20% of your portfolio, seeing as how we were using a $10,000 starting balance. This is just an example. 20% of your account in a single position is not very smart. It's not very practical if you're trying to use good risk management. I would not do that myself. Nobody I think out there would advise doing that. So you definitely want to use a smaller portion of your portfolio, which would bring us into our 10-10-10 rule at the end. But for this example, we'll stick with 20. So factors of risk management, the first one is going to be planning your trade. Now that you know your position size and when you're going to cut loss, you need to plan the trade before you make it. So if you're a swing trader, you have plenty of time to do this. You can do this on a weekend. You can do this after market closes. There's no real rush. If you're day trading or scalping, you got to do this very rapidly. You got to do this during market hours while the price is moving. So it's a lot more difficult. So it's best to start with building risk management habits with longer term trades. This just allows you to, mentally adapt to planning your trade entry, your trade exit, your trade stop losses, all, with relatively easy, computing with your mind or calculator or whatever you're going to use. You will need to plan your entry, your exit, and the price of your emergency exit, aka your stop loss. This plan can be accomplished by using good technical analysis principles and staying modest. Taking what the market gives you, not being greedy. If you take what the market gives you, uh, meaning that you take it when it hits your exit point, the profit target that you've set for yourself, if you take it, then you're modest about it. You take what the market gave you. You're not being greedy. If you try to hold past your profit target, sometimes what will happen is you'll hit your $100 profit target or your $500 profit target, whatever it is, and then it'll start to pull down. And you'll say, well, I already was at 500. I'll just wait. Maybe it'll go back, and it keeps pulling down, and now you're in the negative. So you had your profit target, you didn't take it, and you ended up with a loss. It happens all the time to everyone. It's happened to me. It's happened to you, I'm sure. It's happened to everyone. But the point is, if you stay modest and you keep the greed out of the equation, you will do well as long as you have a decent strategy. So our next factor is taking the gain. So risk management does not only apply to the negative side, it also applies to the positive side. Going into the trade, you need to plan a target to sell at. Without planning a target based off a percentage or dollar amount, or even using technical analysis, you're basically just hoping for the best. So if you don't have a target to sell at, and you're just going to sell whenever you feel like selling, that opens up error, because now you're going to probably end up holding too long and end up taking a loss on the trade, or even losing a lot of that unrealized gain. So you could be up hundreds of dollars only to walk away with a few bucks. Not planning the trade, sometimes it gives you a high gain, sometimes it backfires in your face, and you end up with a loss when you had money waiting on the table. So it all boils down to have a plan. Right? Consistent gains over time is how you build wealth. You don't build wealth trying to create a home run play every time you go into a trade. That'll only work a few times. Historically, with any model you ever look at, historically that is not a long-term strategy, and it ends in with a loss. When swing trading, you can calculate a target based off chart analysis using technicals. When trading faster moving plays like scalps, I personally find it best to use a percent gain target, just based off of what I'm willing to, or what I'm wanting to make on that trade. So, say it's 10%. I get in at $50 on or 50 cents on an options contract. I want to make 10%. So at 55 cents, I'm going to get out. That's 10%. So by using a target like that, I find it a lot more beneficial and a lot easier to do with scalping faster, moving plays, as where a swing trade, I can use technical analysis and chart patterns and all that and kind of figure out where exactly you want to get out. A one-to-one risk works very well for scalps, during shorter time frames. So if you're willing to lose 100, then you want to, try to get out with a profit of 100. In this example, you either win 5% or lose 5%. Whether you in the year profitable has to do with your trading strategies, and again, not the risk management. So say you use a one-to-one risk trading $1,000 positions. So we're using 10% of our portfolio with that $10,000 initial example we talked about before. If you end the year at 65% accuracy, being that your risk is 1-to-1 at a 5%, you either win $50 or you lose $50. At 65% accuracy, this would mean that you will make $150 every 10 trades. So basically you'd have 6.5 trades times $50 profit minus 3.5 trades times $50 loss. You would end up with $150 profit every 10 trades. So at the end of the year, with 65% accuracy on all your trades, you would basically average out to $150 profit per 10 trades in that example. Now you could hit a winning streak where you would win more, You might end up on top higher than that $150 every 10 trades. You could have hit multiple trades in a row that were wins. You could have hit 10 trades in a row that were wins. So your 10 trade average would be a lot higher. Or you could hit a losing streak and it would be the exact opposite. But all in all, you should end up finishing out on top at the end of the year, just by this simple example. And the last example, or not example, but the last factor of risk management is going to be cutting loss. So you had a plan going into the trade, you entered the trade, but unfortunately it went against you. So no worries, this happens. It happens to everyone. No one has 100% win rate. No one has 100% accuracy, not even the best hedge fund out there, not even the best trader out there. Don't care who you are, you have taken a loss. Luckily, you've planned for this. So you entered the trade on a ticker that cost, say, $5 at the time of your entry, with $2,000 position size, right? So you took 400 shares. You put in $2,000 divided by $5 a share. You took 400 shares, but that trade went against you, and now you are at a 5% unrealized loss. All right, so this is how proper risk management can help you manage your trade. So being that you planned the trade before you entered, you knew to cut your loss at $4.75. So you put your stop loss in for $4.75 right after you entered. So as it swung down and hit your 5% mark, you got stopped out of the trade and you incurred no further loss. Now this could continue to crash down and go into deeper loss, doesn't matter. You got out. Or it could bounce back up and go and shoot for very high profits that you would have had. And it doesn't matter. You followed the plan, you got out when you were supposed to get out. Whatever happens after that, it doesn't matter. Something's always going to happen after that. You could have either lost more, or you could either have, made money. It doesn't matter what happens after you get out. A lot of people will see, they'll get out even at a profit of 10% profit, and then it just shoots up and they would have had 50%. And they're like, oh man, I would have had all this money. But hey, at the end of the day, all that matters is you ended up following your plan. As long as you stick to the plan and you have a profitable strategy, you will finish the month, the year, your life. You will finish green, and that's all that matters, is that you finish green. A big portion of retail traders, they lose money. I'm sure you've seen that statistic out there where 90% of traders lose money. There's that 10% of traders that are successful, and that's probably a little skewed. I mean, that statistic's been around for decades, so I doubt it's really relevant anymore with today's technology. I'm curious if anybody has a relevant statistic. If you do, shoot it down in the comment to, some type of case study or some type of survey. But yeah, that statistic's been around for a while. You want to have good risk management plus a good strategy that keeps you in the winning percentage. So overall, back to this trade, it would equate to a $100 loss or a 5% loss, which is exactly what you planned for. And last but not least, we were going to talk about the 10-10-10 rule, and that is what's up next. This is the 10-10-10 rule, which is something that I came up with over time. It's great for any trader regardless of your experience, and it's very simple to use, to implement. It's comprised of three main elements. I've used this, many times. People I know have used this with great success. People I know still use it. But basically, it's comprised of these three main elements, and that is your position size does not exceed 10% of your portfolio. So on a $10,000 portfolio, you would not exceed $1,000 per trade. You take no more than a 10% loss per position. So you cut loss at $100 on a $10,000 portfolio. This is all going to be based off of $10,000 portfolio. So you would cut loss at $100. You target a 10% gain. So you take profit at $100. Using this rule, you can never lose more than 1% of your portfolio per trade, because 10% of 10% is 1%. So you could make tons of bad trades in a row and you're only going to lose 1% each time of your entire portfolio. This allows you to hit a losing streak and still come out on top. You could hit a winning streak and that might be the case. Or you could hit a losing streak right off the bat and lose 10, 15 trades in a row just, to end up winning and winning and winning and hitting a long winning streak. So you definitely want to use a small portion of your portfolio when you're going into trades, because it allows you to um, basically account for that losing streak that could happen. Using this rule, you can never lose more than 1%. Like I said, it's a great tool to have in your pocket, whether you want to use it or not. In this example, with our $10,000 balance and $1,000 per trade, you would either make $100 or lose $100, which brings us back to that one-to-one risk example, where if you had 65% accuracy in your strategy, you would come out on top. Now, depending on your count size, numbers may vary, right? So even if you're starting with $1,000 account, you could still apply this. If there's zero fee brokers out there, so a lot of you might be saying, well, if I had $1,000, I wouldn't be able to do this because there's no way I could take $100 and exit on a $10 loss. That's just not feasible. Well, that's not true. You can do that even with $1,000. There's zero fee brokers out there. I'm not gonna, advertise any of them, but you know who they are. There's a bunch out there. So if you focus on good risk management while you build your account up the proper way, even with $1,000 starting amount, you can still make good trades. All right, so let's take a look at an example trade here. We'll pull up our broker platform, running on our simulated account here. This is AMD. Current price, it is October 5th. It's about 2:54 in the afternoon Eastern time. And for simple math purposes, let's just say that we entered this trade right around the whole dollar bounce of $27. So we came down, we fluctuated for a while, and we were like, hey, it's bouncing off this whole dollar mark. We're going to enter in at 27. We got filled, and so now we need to define our risk management. Going into the trade, we knew we were going to try to fill at 27. So now that we did that, we need to define our points of where we want to exit for this swing trade. So let's say that we're using the 10-10-10 rule, and we factor in that to our current trade. So entering at $27 flat, we want to make 10% on the trade. So we're going to times 27 by 10%, and we get 2.7. So we need to move this up $2.7. So our horizontal line here is going to be $2.7 on top of our initial entry of 27. So you just add your 2.7, it gives you 29.7. So we'll add 29.7 here. And we'll add another horizontal line, and that is going to be our stop loss. All right, so you'll take your $27 entry and you'll minus 2.7 because we're using the 10-10-10 rule here. We're taking 10% or losing 10%. And that'll give you 24.3. So we'll add 24.3. And we'll swing this to a larger time frame just so you can see all this together. Maybe we'll bring up the 30-minute here. With the 30-minute there, just disregard here. Let me move these out of the way. This is from earlier. Oh, gotta go the other way with that. Move these out of the way. All right, there we go. So with our 10% stop loss, factored in here, we can use 29.70 as our profit target, and our stop loss would be down here at 24.3. Again, so we entered this trade on the whole dollar bounce. We saw it bounce around there once, came back up, bounced around there again. We got filled at 27, hypothetically. So we're looking for it to either come up to 29.7 or break down to 24.3. Either way, we get stopped out, and we're only going to lose 10% on this trade of our initial entry, which was set to $1,000. We actually ended up less than $1,000, filling at 27. But on that $1,000, if we would have lost 100, we would be right at 10%. And on our overall portfolio of 10,000, we would only have lost 1% on this entire trade. So that is how you would use the 10-10-10 rule. If you guys, again, have any questions about the 10-10-10 rule or anything covered in this risk management lesson, feel free to comment in the comments below, or again, go to retailegotrader.com and shoot me an email. My name is Chris, and have a good day. Thanks for tuning in to the Retail Algo Traders YouTube channel, where we provide education, tools, and mentoring. Visit retailalgotrader.com to get custom indicators, automated strategies, and mentor sessions. Be sure to subscribe to this YouTube channel so you can get the latest content we create. And as always, happy trading.